So hi guys, in our today's video we are going to look at the 5 types of companies that everyone should avoid. Just a short note that this video is purely for educational purpose, so kindly do your own research before making any investment. So firstly we would be going to screener, and then we would be going to screens and then create a new screen. So now the filters, we would be entering our filters. So first will be debt to equity greater than 1.5 and market capitalization greater than at least let's say 1000, and interest coverage ratio is less than 1.5. So let me just explain all these three filters. So the first one indicates that a debt to equity greater than 1.5, which means that the companies is actively using a high financial leverage to fund their operations or growth, and the market capitalization greater than 1000, which indicates that it is largely an established entity. And interest coverage ratio basically means that a company's ability to pay the interest on the debt that it already has. A higher ratio basically indicates that company can cover their interest payments very comfortably. So in this scenario we have taken less than 1.5, which basically indicates the sign of financial stress. So now let's run this query. So these are the 87 results that we have got. So let's just pick any one of the companies and just verify our filters. So first is debt to equity greater than 1.5. So here we can already see that the company has a debt to equity of 22.7, which is much higher, and we can already see the trend here as well, as the stock price is well below the 50-day moving average and 200-day moving average as well. Now, there are also some of the cons that have been mentioned, that stock is trading at 30 times of that of the book value. The company also has a low interest coverage ratio, so the last criteria which we had entered, and the promoter holding has decreased over the last quarter, which is 0.39%, and promoters have pledged almost 41.4% of their holdings. So these are the cons that this company has. And also in terms of the PE value, it is slightly overvalued. Now I want to check the borrowings. Yeah, so borrowings. Here we can see that the company has a reserve of 77 crores, but the borrowing it has of 4,794 crores, which totally indicates that company is heavily dependent upon the debt to fund its operations. So now we can also see in the stock chart that the stock chart is well below the 50 and 200-day moving average. So and we can also see an increasing trend in interest as well. Let's see. Inventory days per working capital gain is also negative. So this was the first type of company. So it is purely a high debt company which has a market cap of greater than 1000 and interest coverage less than 1.5. So now let's look at the second type of companies, which is a company with low sales or let's say falling profits. So for that filter will be profit for growth, let's say 3 years less than 0, and market capitalization greater than, let's say, 1000. So it basically indicates that a company which is a large and established is currently struggling to make profits, or maybe it is an undergoing in a transition phase, or they are heavily reinvesting in future. So let's run this query. So these are the 288 results that we have got by applying the filters. So let's pick any one, let's say this. So let's analyze this company. So first we can see the chart. This is the chart which is still below the 50 and 200-day moving average, and these are the pros and cons. The pros, that the company is almost debt free, the company has a good ROE track record of 47.8%, and the company has been maintaining a healthy dividend payout of 71.8%. Remarkable. And the con is that the stock is trading 9.95 times of its book value, and the company has delivered poor sales growth, which is minus 8.74%, which will also reflect in the profit, the filter that we had entered. And it is, however, undervalued, the PE. Now let's look at the quarterly results. So here the quarterly results, we can see a trend, which is March 2025 536, June 2025 406, 475, and so we can see that there is a decline from March 2025, which is minus 12%, and then negative minus 9.27%, as a result of which it is being covered that that the company has delivered poor sales growth of past 5 years. Okay, let's look at the P&L as well of the years. Yes, from the December 2020, what we can see is there is a negative minus 5.49% of the sales, and then 1.88%, which we can totally assume that because of the COVID-19, it may have been affected. And then from December 2022, it is minus 6.31, and then 2% they have slightly recovered, and then minus 29% in 2024, and minus 8% 8.73, which states that the company is currently struggling with sales, as there is a negative trend which we are seeing. And let's see if the net profit as well. So the net profit also, we can see that the net profit has been decreasing from December 21 621 crore, then 603 crore, 414 crores, and 327 crore, which also states that the net profit has been decreasing over the last 3 to 4 years. It is based on the filter that we had entered, and then this is the balance sheet, which is equity, capital, reserves. The company has reserves. However, the company has low borrowings, which is a little bit plus point. Total average fixed average investment, other assets, and all, which cash from operating activities. This profit from operations, 474 crores, receivables, inventory, cash flow from investing activity, fixed asset purchased. Okay, fixed assets sold. Company also sold some of the fixed assets as well. And then from financing activities, the one thing is good that the company is a dividend paying company. Debtor days, the inventory days payable. And the promoters are currently holding around 60.40%. So that another good thing is that the promoter share has decreased. Okay, very good data from DI. Some of the domestic institutional investors like LIC, Nippon India Life, SBI Magnum Mid Cap Fund, SBI Nifty Small Mid Cap Fund have also been invested in this company as well. So, however, all these types of company require a deeper analysis. Right now, we are just going through, but we are not going much deeper. But these types of company require a deeper analysis, because it's very important to determine that if they are restructuring for future growth, or all of these companies are in a terminal decline phase. So now we would be looking at the companies which has pledge percentage of more than 30%. So just a short note, pledging basically means that the founders of the company use their shareholding as a collateral in order to secure loans from bank or other financial institution. However, pledging is a standard tool to raise funds, but however, a level above 20 to 30% basically shows signs of financial strain, which can lead to volatility in stock price. So we would be entering pledge percentage greater than 30% in our filter. And now we're going to this query. So there are 205 results which has a pledge percentage of more than 30%. Now just let's pick any one of them. I'm sure it must be written here. Yes, the here we can see that the promoter have pledged more than 41.4% of their holdings. So ideally our benchmark was 30%, but in this case they had pledged 41.4% of their holding. So just a short note that a promoter pledge is not only the one factor that you need to consider while investing. However, other factors also needs to be taken into consideration before investing. So the fourth type of company which we would be looking at is negative cash flow companies. So for that, we would be entering filters like cash from its operation last year. Let's see, less than zero, and net profit greater than zero. So this filter basically indicates that a business is earning the accounting profits, but those profits are not being readily converted to cash. So maybe this discrepancy also may arise because that the firm is expanding rapidly, or maybe they are managing working capital poorly. So let's run this query. So these are we have found 1508 results out of that. Let's pick any one of them. So here what we can see, let's look at the cash from operation. Here we can see that the cons are that stock is trading at 345 time of its book value. Though the company is reporting repeated profits, it is not paying out dividends, and the company has a high debtor days of around 220, and the working capital days have increased from 43.2 to 83.1 days. So as the criteria we had mentioned, the company has is not maintaining their working capital effectively, which is 43 to 83. Now let's look at the cash from operation. It has to be negative. This, yeah, so cash from operating activities is negative, as we can already see. But however, if we look at the net profit will also be negative, just slightly. From March 2025 to 2026, they have started earning profits. So they are earning the accounting profits. And if we look at the debtor days, then debtor days from March 2024 was 201, March 25 was 162, and 26 is again 219. The debtor days has increased a lot, which basically states that company is not collecting their cash effectively, and however they have a company has a low quality earnings. So now let's look at the last types of company which one should avoid is overvalued companies. So the company with price to earnings greater than 80, and sales, let's say sales, let's select 3 years, sales for 3 years less than 10. So a company with a price to earnings greater than 80 basically suggests that there might be a market hype around, or maybe there is a social media buzz. So now let's run this query. So we have found 211 results. So let's pick any one of them. Sales and chickens. So here the debt to equity price earnings. So we can see that the PE is around 111. So these are the pros and cons of the company. The cons is that the company stock is trading 7.78 times of its book value. The company has a low interest coverage ratio. The company has delivered poor sales growth of around 11.8% over the 5 years. And the debtor days have increased from 41 to 57, and the promoter holding has also decreased in the last 3 years, which is a negative 4.66%. Now here we can measure the PE very effectively. The price to earnings, here the synergy green, it has 110.66. However, the median industry PE is around 26.04. So it's very much overvalued. So compared to the valuation, so let's check its performance as well. So the quarterly results, we can see that there is a, from June to September there's a negative 19% and 5.46%, and profit before tax. Now let's look at the sales in terms of years perspective. So here what we can see is the filter was, yeah. So our second filter was sales growth 3 years less than 10%. So from 23 to 24. So here we can see that it grew around 2% from 22 to 23, and 12% from 23 to 24, and 11% from 24 to 25. So it is averagely less than 10%. And the profit, if we look at the profit, then profit has considerably increased from 23 to 24 and 25, and it is 12. This is the equity reserves. The reserve is 96, and borrowing. The company has borrowing greater than that of reserves. So, however, these are the cons that as they have summarized for this. So, however, one red flag may not make the stock bad, but we need to take into consideration all the other factors as well. So, however, the motive of this video was purely for educational purpose, and it is from a learning perspective. It is not an investment or stock recommendation. So it is just to explain that what are the types of filters that we can use, and the types of companies that we should avoid based on these filters, because those filters that we had entered today were unhealthy for the companies. So hope you enjoyed it. See ya. Thank you.